Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, hey everybody.
Hey Lauren, I was reading an article in the last Sunday's Seattle Times business section by Chuck Jaffe, and it was a good article because there's been a lot of promotional and chatter I've seen about these free ETF traded funds out of the Schwab ETF OneSource platform. And basically the ETFs are a little bit different than index funds, as you know, as we both know, because they are actively traded throughout the day, unlike an index fund, which is balanced at the end of the trading day. Real quickly, can you maybe explain what an ETF is?
As opposed to an index fund?
Right, or just what even an ETF is.
So ETFs are always supposed to track an index, although some of them get so weird that it's hard to know what index they're tracking. But an ETF doesn't actually hold any stocks inside it. Instead, it's traded like a stock, and it's just supposed to represent or track an index. But it can be traded throughout the day like a stock. So what that means is if you buy or sell an ETF, it's just like a stock. You don't, when you buy a mutual fund, you just buy it at the price that it says it's at. As an ETF, you don't know exactly what price you're going to buy it at because there's a bid and an ask, just like when you trade a stock. So ETFs are a little weird because over the long run, they really should just track the index, assuming that they actually really are tracking the index. I mean, when there are infectious disease company ETFs, I don't really know what index they're tracking, but they're supposed to track an index, but they're traded like a stock. So they're a little weird. And
and as part of that, one of the reasons I don't really care for them is because there are an active amount of traders that are shorting them during the day. There's an active amount of traders that are buying and selling them rapidly throughout the day. And then they're getting to be all kind of variations of ETFs that are like trading some, like you said, weird index, or they're making up their own, or they're now becoming active, or they're trying to, so they're kind of going away from the classical capturing the different markets of trading. But in this article, Schwab is really promoting that, hey, you can actively buy and sell these ETFs with no trading fees. And as I start looking into the details, and I'm going to title this episode, with ETFs, there's no free lunch. Because they say that, yes, that's correct, you don't have to pay the trading share, but if you look at the fine print, the ETFs that are being offered through this platform are first of all, the sponsors of the fund of the ETFs are paying Schwab a fee, so there's higher fees likely going to be associated with those ETFs, and they're picking their least popular ETF funds to put on this platform.
Of course.
And that means that there's very low liquidity because there's low trading occurring, and that also means that the likelihood is there's going to be a higher bid-ask spread in those specific funds.
So you won't technically be paying a fee, you'll just be paying a large spread between what it should cost and what you're actually paying.
Correct. And then the last thing, and this is the thing that bothers me the most, is they say that if you want to have a well-diversified global portfolio, the type of ETFs that are available on this platform do not give you that comprehensive global diversification that we're looking for. So I think that the takeaway from this is again, there is no free lunch. You're going to be paying it some way, and the more important thing from our point of view is to have true diversified global exposure in different asset categories, and this may not be the right way to get that. So,
and trading hundreds of times per day is definitely not the right way, no matter what you're trading.
Exactly. Well, thank you for watching this episode of Erickson TV, and we'll see you next time. Bye now.
See you next time.